This is how I paid just 3% tax on £64,000 on this flat right here. And I'll also cover a strategy so you can pay 0% tax legally regardless of what the Labour government does. First, we need to reduce the tax on the monthly income of this flat. So I bought this flat in 2019. It's a 2-bedroom flat. You have the first bedroom here, then you have the main bathroom, you have an open plan living room here, and then through the open plan living room, you have the second bedroom. Now, this flat is between Borough Station and London Bridge Station in London. The market rent for a 2-bedroom ex-council flat in this area is around £2,350. Now, my mortgage on this flat is £1,099. I got this mortgage a few years ago, so when I do get a new mortgage, the rates probably will be slightly higher than this. The service charge is around £100 a month. Now, because this is a flat, I have to pay a service charge. The maintenance, I normally account for around £200 per month. I self-manage the property, so that doesn't cost me anything. And so my profit is around £951 per month. Now, let's assume you own this property in your personal name and you're a high rate taxpayer. So that means you're in the 45% tax bracket. Now, let's say you rent this property out for £2,350. You can then offset all of your costs, like your management costs and your maintenance costs, but you can't offset your entire mortgage because you own this property in your personal name, and that's not how the tax laws work. So once you offset all of your costs, that means you have a paper profit of £2,050. So a 45% tax on £2,050 is £922.50. But on top of that, what you can do is, if you own the property in your personal name, 20% of your mortgage interest you can then deduct as a cost. So if your mortgage interest is £1,099, well, 20% of that is £219.80. So essentially, your tax bill is £922.50, but then you deduct the 20%, which is £219.80. You end up with a tax bill of £702.70. So now you're in a situation where this property is only making you about £951 profit, but from that £951, you are paying a tax of £702.70, which is essentially a 74% tax. And by the time you pay that tax, your actual profit is only about £248, plus you have the hassle of managing the property, maintaining the property, renting the property out, and maybe that's not worthwhile. Now, maybe you're not in the 45% tax rate, maybe you pay the basic tax of 20%, or maybe you pay 40% tax. If you want to know exactly what your tax bill would be, you can use this calculator by Tax Scouts, which I'll link in the description below. So go to the rental income tax calculator, scroll down, choose buy to let, put in your monthly rental income, so it's £2,350 in this case, and then put in your annual salary. So let's say you have a salary of £50,000, any other income from investments or whatever you can add in there as well, and then click to add expenses. So our monthly mortgage interest is £1,099 because the entire mortgage is an interest-only mortgage. And for other expenses, we said £100 service charge and a £200 maintenance bill, so that's £300. And so here it tells you your earnings from the rent, which is £28,200. From there, you have to pay a property tax of £7,148, and your after-tax rental income is £4,264. Now, if you're in a higher tax bracket, and so rather than earning £50,000, you earned £150,000, you can see that your after-tax rental income drops massively to just £2,980 per year. And if you want to see exactly how these things are calculated, you can scroll down and you can click the calculation details where it will explain to you step by step how this is broken down. So if you want to pay just 3% tax on £64,000, this is the first thing you need to do. So rather than buying this property in your personal name, if you bought this same exact property in a limited company, this is what the numbers would look like. If we use the same numbers again, your profit is £951. But now, because this property is in a limited company, you would pay corporation tax as opposed to income tax. And so with corporation tax currently being at 19%, well, 19% of £951 is £180. Now, you could reduce that even further by having tax deductible expenses. So what that means is if you have a company car, or if you have a company phone, a company laptop, if you use a home office and those sort of things, that would bring the tax down even further. But let's not get into that too much because that's a whole another area, and let's just keep it simple for the time being. So just by doing that, you've gone from 74% tax to 19% tax on your income. So that's how you save tax on the property income. Now we need to work out the big thing, which is how do you save the most amount of tax when the property value goes up because of capital depreciation, or maybe because you do a refurb to the property and make it worth a lot more money compared to what it was before. Now, for context, like I said, I bought this property in 2019 and it's currently a 2-bedroom flat, but I actually bought this in terrible condition as a 1-bedroom flat, which I then converted into a 2-bedroom flat. So I bought this property for £330,000. I paid a stamp duty tax of £16,400. My refurb cost me £26,850. My legal fees came to £3,227. And then I had finance fees, which were pretty high because I got bridging finance, which is short-term finance, for £20,488. And so the total cost came to £936,965. So once the property was converted into a 2-bedroom property and redone up completely, it was then revalued by a new bank at £450,000. And so that meant I made a profit of £53,000. Now, this is where the problem comes in, because normally when you make a profit, you then have have to pay capital gains tax. So to work out how much capital gains tax you have to pay, you can use the TaxCalc capital gains tax calculator. So scroll down, select property, enter your profit here, which is £53,000. And let's say you're a basic rate taxpayer. Now, in the UK, these are the current tax brackets. If you earn up to £12,570, you don't pay any tax. The basic rate tax is between £12,571 and £50,270, on which you pay 20% income tax. This is very different to capital gains tax. And then above that, you have the higher rate tax and then the additional rate. So if you're a basic rate taxpayer, you earn anywhere in between these two figures. So let's say you earn £50,000. Now, in this case, the profit from your property is £53,000. The first £3,000 of that is a tax-free capital gains allowance. Now, on the remaining portion, your tax bill is £11,984, and so therefore your profit after tax is £41,016. Now, if you want to see a breakdown of how that's calculated, you can scroll down and click here. And so if we simply scroll down, again, your profit is £53,000. The first £3,000 is your capital gains allowance. Now, this is where the tax comes in. You pay a £49 tax at 18% tax rate. Now, if you're a basic rate taxpayer, your capital gains tax is 18% on the next £270. The reason for that is because if you earn £50,000 a year, when you earn another £270 on top, after any money you earn above that, you're no longer in the basic rate tax pay because your combined income that year has now gone over £50,270. So on the first £270, you pay the lower tax rate of 18%, which is £49. If you're a high rate taxpayer and you fit into this category, you have to pay a capital gains tax of 24% on the remaining profit of £49,730. Well, 24% is £11,935. And so therefore, your total tax bill comes to £11,984. Now, in this scenario, if you were a high rate taxpayer, and so let's say you have a salary of £100,000. Now, when you earn £100,000, it doesn't actually change the tax that much because in both scenarios, the bulk of your capital gains fall into the higher 24% rate because your combined income in both scenarios very, very quickly goes above £50,270. Now, as you can see, everyone is in a different situation and what your tax bill is will depend on your personal circumstance. And so that is why it's very important to get personalized tax advice when it comes to anything to do with your property accounts. And TaxCalc is one of the great companies which can help you do that. They have amazing reviews in Trustpilot. They can even help you with your self-assessment tax returns. So if you want that tailored advice, get in touch with TaxCalc. They will be able to tell you what is the best decision for you in your situation to make sure you're able to not just make the most amount of money, but to save as much money as possible on your taxes. Right now, new users can get 10% off, so click the link in the description below and get started. Now, to reduce this tax and to get to 3% tax from £64,000, you can do two things, the second one being a lot more powerful. Now, firstly, again, if you bought this property in a limited company and not in your personal name, once you made the profit of £53,000, now because this property is in a limited company, you wouldn't pay capital gains tax. That's what you pay if you as a person own that property. In this case, you would then pay corporation tax, which starts at 19%, which is significantly lower than what capital gains tax potentially could end up being. Now, once you paid corporation tax, the money is still in the limited company. You can then pay that to yourself through income or through dividends. And there are different ways of doing that in order to make that more tax efficient. So now this is the more powerful strategy, and you can do this in your personal name or in a limited company. So if we look at the figures again for this property, I bought this for £330,000, but I put down a 25% deposit, which is £82,500, and I got a mortgage of 75% loan to value, which is £247,500. Now, once the property was converted into a 2-bedroom property, like I said, it was worth £450,000. At that point, rather than selling the property, I remortgaged the property, which means I essentially got a new mortgage on this property based on the new value of £450,000. So a 75% loan to value mortgage based on the value of £450,000 comes to £337,500. Now, when I get that new mortgage from the second bank, I still owe my first mortgage of £247,500 to the first bank. So I take the £337,500, I repay my first mortgage of £247,500 to the first bank. So now the first bank is completely paid off, and that means I am left with £90,000 in my bank account. Now, if I bought this property in a limited company, that money is in my limited company bank account, or if I bought this in my personal name, that is in my personal bank account. But that £90,000 which I've taken out of the property, and I've been able to do that because of the fact that the property is now worth a lot more money because I've added value, that £90,000 is completely tax-free. Every time the value goes up and you refinance that property, you never have to pay any any tax because all of that is a loan and not an income. So the monthly profit on this property is £951 per month, which is £11,412 per year, on which you just pay 19% tax, which comes to £2,168. And on the £53,000, which is the uplift, the profit, you don't have to pay any tax. So on your total profit of £64,447, you pay just £2,168 in tax, which comes to about 3.4% tax rather than what you would pay normally. But keep one thing in mind, even though this money is tax-free, this money is now in your limited company rather than in your personal bank account. Whereas if you own this property in your personal name, not in a limited company, when you refinance this property and you get a new loan, all of that money goes into your personal bank account and then you can do whatever you want with that money. So now to see whether it's better for you to buy a property in a limited company or your personal name, you really need to get specialist tax advice before you make that decision. So click the link in the description below and you can get in touch with someone at TaxScout in order to make sure you're making the right decision, whether it's buying a property in a limited company or in your personal name, and if it is a limited company, helping you get that company set up and running.